So welcome. I'm Stephen Isaac, a partner in our Audit, Assurance and Risk Consulting division, and I will be your host for today. Joining me today are Kayleen Hubbard, a fellow partner, and Shara Learmonth, a director, both with clients that operate in the not-for-profit sector. Also joining us is Julie Locke, a director, and Bruno Romeo, a manager, both from our Department of Professional Practice, a group that helps clients and KPMG staff with interpreting and applying IFRSs and other Australian financial reporting requirements. As all of you know, the not-for-profit sector is currently being impacted by an unprecedented level of change and uncertainty. The pandemic has increased the demand for the services you provide and the purpose for which your organisation exists. Operationally, this challenge is compounded by the significant workforce recruitment and attraction challenges faced in the current labour market. Financially, the recent inflationary pressures, as well as impacts on returns from the recent global market volatility, are increasing pressure on your results and the ability to invest with confidence in your benevolent activities. Many of the sectors your organisations operate in have also been subject to increased scrutiny, review, and impending change from a regulatory perspective. Your financial reporting obligations have also not been immune to proposed changes. It seems like the Australian Accounting Standards Board has been discussing a new financial reporting framework for many years, and we are finally seeing a renewed focus on what that will look like and mean for not-for-profit entities, as well as some new requirements this year for who needs to prepare financial reports and what disclosures to include. Over the last 12 months, we've also seen local and international focus on ESG matters, including, but not limited to climate, and these have really gathered pace with an increased level of expectations from all stakeholders, including your employees, providers of capital, and your supporters. Many not-for-profit providers, by virtue of your purpose, have a great story to share, but from our experience are grappling with keeping up to date with developments and how best to do this. All of these competing priorities mean that you need clarity in terms of what's changed and what's upcoming in your reporting and compliance obligations. And through this webinar, it is our aim to help provide you with that today. With all of this in mind, let's have a look at our agenda for today. In today's webinar, Shara will discuss new developments on ESG and the role service performance reporting will play in this space as it relates to not-for-profit organisations. Kayleen will provide us with an update on tax and regulatory matters and talk through topical tax issues relevant to not-for-profit organisations. Julie, Bruno and Shara will then take us through several financial reporting reminders, including new accounting pronouncements, developments in the not-for-profit financial reporting framework, reporting changes from the ACNC, SSB developments, as well as some sector-specific developments for those of you who either fundraise or are aged care providers. I'll then return to wrap things up and answer questions in our Q&A session. So if you have any questions, then please do submit them using our Q&A function, and we'll try to address as many of them as possible at the end of the webinar. If we do not get to your specific questions, we will answer them for your usual KPMG contact separately following today. And with that, I'll pass to Shara to kick us off.
Thanks, Steve. So as Steve mentioned, ESG has gained significant prominence in the market over the last 12 months. For those who are not aware, ESG stands for environmental, social, and governance. Environmental factors relate to an organisation's impact on the environment, both positive and negative, and reaches beyond the organisation's own impact, but to those of the organisations it deals with in its value chain. From a not-for-profit perspective, this is the area where we've typically seen the least amount of strategic thinking. However, it is increasingly important given the momentum in the climate change agenda in Australia. Social factors relate to the rights, well-being and interests of people and communities. This is an area that most not-for-profit organisations have a really positive story to tell. A number of the larger not-for-profit organisations are starting to put pen to paper on their social impact in relation to the UN Sustainable Development Goals and integrated reporting, to understand their strengths as well as opportunities in this space. Governance factors relate to the governance practices of organisations, including ESG factors in policies and procedures. This is an area we have observed an increasing level of conversation at the board level. Not-for-profit boards are increasingly wanting to understand each of the ESG factors within the organisation and want strategy developed with a lens on ESG. Consumers' expectations around ESG have steadily increased over the past 10 years. Our 2021 CEO Outlook survey highlighted that 30% of CEOs are planning to invest more than 10% of their revenues toward becoming more sustainable. This affects every single organisation in every sector and in every geography. All organisations are facing pressure from investors, regulators, customers and employees to transform businesses with an environmental, social and governance lens on all that you do. ESG is no longer a siloed concept, but something that needs to be embedded into an organisation's entire strategy and operations. ESG reporting is the disclosure of environmental, social and corporate governance data. Its purpose is to highlight an organisation's ESG activities whilst also improving stakeholder transparency and inspiring organisations to do the same. What and how to execute on ESG can be complex and confusing given the number of standards and approaches and the pace of developments. In response to the growing global demand for high-quality, transparent, reliable and comparable reporting of sustainability-related information by entities, the IFRS Foundation established the International Sustainability Standards Board, also known as the ISSB, on the 3rd of November 2021, off the back of the COP26 conference in Glasgow. In March 2022, the ISSB released 2 exposure drafts on general sustainability and climate-related disclosures. These are heavily based on the Task Force on Climate-Related Financial Disclosures, or TCFD disclosures, and the Sustainable Accounting Standards Board standards. In October 2021, the AASB released a consultation paper seeking views on whether some of the AASB inactive projects, including sustainability reporting and service performance reporting, should be considered as potential projects for their 2022 to 2026 work program, stating that sustainability and service performance reporting would likely be closely related. In April of this year, the AASB released ED 321, General Requirements for Disclosure of Sustainability-Related Financial Information and Climate-Related Disclosures. Now, this is a part where you all breathe a sigh of relief. Feedback from that consultation paper indicated that sustainability reporting for not-for-profit entities is significantly different to sustainability-related reporting for for-profit entities. Consequently, to assist the AASB in moving forward in this project, a decision has been made to focus on the development of sustainability-related financial reporting requirements for for-profit entities, with not-for-profit entities to be considered at a later stage following additional outreach and research. The AASB is continuing to pursue service performance reporting for not-for-profit entities, however, is considering consultation feedback and will decide the direction of the project in the second half of this year. So it is a bit of a continue to watch this space still. Whilst it is unlikely sustainability reporting standards will be mandatory for not-for-profit entities in the near term, most of you have a really strong story to tell regarding your social impact. There remains a great opportunity to start promoting how your individual organisation is contributing to the ESG story, but also to stand back and understand what your internal and external stakeholders view as important and embed that into your future strategy so that all decisions have an integrated sustainability lens ahead of any potential formal reporting requirements in the future. Transparency from an ESG perspective will also likely open up partnering and financing opportunities as the for-profit sector is increasingly looking to partner with ESG-conscious organisations. And to make this real for you, there are a few examples of not-for-profit organisations who have published publicly available reports on their alignment to social and governance factors, which I encourage you to look at. The first example, which I put up on the slides for your reference, is Camp Quality, who release an annual integrated report which publishes the social impact the organisation is having against their stated goals. The second is Uniting New South Wales ACT, who have recently released a report on their alignment with the UN sustainability goals. I'll now hand over to Kayleen for some tax and regulatory developments.
Thanks, Shara. As Stephen said at the outset, I've just got a few words to say around some changes that have happened in the not-for-profit regulatory landscape and some cases that have been handed down in the last 12 months that it's important to be aware of. The regulatory changes that have occurred in the last little while are those involving the ACNC and the ATO, which are the main regulators that not-for-profits are interacting with on a regular basis. The watchwords, as ever, from an ACNC and ATO perspective are governance and compliance. The reforms and the case law really are very much directed at those two themes. Just on that, though, it is important to note that the approach of the ACNC and the ATO is very much to collaborate with the sector, to be engaged and involved rather than wielding a big stick. And as I say, those reforms are very much directed at assisting with that process. In that regard, of the 56,000 charities that are currently registered in Australia, although it's probably more as there are being more added every day, the ACNC only revoked 15 registrations in the 2021 calendar year. So again, that is indicative of the willingness and the appetite of the regulators to engage proactively with the sector. Bruno will discuss this in more detail from an accounting perspective, but just noting really broadly in terms of reporting and what is required from various charities depending on their size with the ACNC. From 1 July 2022, so this will apply to reporting for the year ended June 2022, financial reporting thresholds for ACNC registered charities have changed. So you can see there on the slide, a small charity. So these are charities that are only required to submit an annual information statement. They are now charities with annual revenue of less than 500,000, which is lifted from the previous threshold of 250,000. Medium charities, which are those who are required to submit reviewed financial statements along with their annual information statement, the threshold there has lifted from 250,000 to $1 million. 3 million it's now. It was $1 million, now it's 3 million. Large charities, these are charities with revenue of 3 million or more, where the previous threshold was 1 million. And so these charities are the ones that are required to submit audited financial statements as well as their annual information statement. There are some other changes to reporting by charities, specifically to do with accounting standards and reporting of other transactions that charities enter into, but Bruno will discuss those in more detail later on. Two other regulatory changes which I thought were worth mentioning briefly, the first being the requirement for all DGRs to be registered with the ACNC as charities. Now, many of you will recall that in 2017, as part of the federal budget, the government announced at 4 reforms that were directed at DGRs and the way DGRs are regulated in Australia. This reform is the second of those 4, and it basically looks at all existing non-ACNC registered DGRs now being required to be registered with the ACNC. So there are 49 categories of DGR in Australia, and previously, before this legislation, 11 of them were not required to be charities. So this requirement essentially is that by the 14th of December 2022, these entities now need to apply for registration with the ACNC. So the charities that we're talking about are those on the Environmental Protection Register, cultural organisations, welfare and rights organisations, some education organisations, and also public funds for hospitals. What this essentially means, and as I say, the deadline for charities, for DGRs to do this is by the 14th of December of this year. But what this essentially will require is a review of constitutions and constituent documents, just to make sure that they meet the ACNC's requirements for registration, and changes to be made if necessary, and to go through that registration process with the ACNC. There is scope to apply for an extension for another 3 years, but that extension needs to be granted by the ACNC, and it also needs to be applied for within that 12-month window to 14 December of this calendar year. The other reform which will impact the not-for-profit sector, not charities as such, but the not-for-profit sector and those entities within the sector who are not registered with the ACNC but self-assess as being tax exempt. So these are entities such as sporting clubs and those sorts of entities who are non-taxable, but there is no requirement for them to register as such. This federal government reform comes into effect from the 1st of July 2023, and it relates to reporting with respect to the 2024 financial year. So there's plenty of time to get ready. But what it essentially is going to require these entities who self-assess to do is to submit a self-review form annually to the ATO, which has not been developed as yet, but will ask a lot of questions around what the activities of the organisation are, where the funds come from, where they're directed to, and other such questions. Now, early indications are that the form is essentially going to be asking similar questions to those questions that organisations, in theory, should be addressing on an annual basis anyway, in order to annually self-review their self-assessed tax-exempt status. So it should not be information or questions which are foreign or haven't been seen before. But as I say, the actual form hasn't been developed yet, and I suspect that that's probably got a lot to do with the delay around why it's taking a while for this to be implemented. The ATO has indicated that when they receive the first lot of self-reports, if they do find that there are entities that really should be registered with the ACNC but have not done so before, they will work very proactively with those entities to ensure that they do get registered, rather than going back and focusing on historic non-compliance. Again, it's that proactive and engaged approach to the sector which they're seeking to apply with respect to this reporting. The ATO has also said they'll streamline reporting, so to the extent that after the first year, answers to the questions can be pre-filled in the subsequent years, the ATO will do that in order to streamline and make the reporting as efficient as possible. The other thing to note is the ATO is working closely with the sector to design the self-review system. Consultation opened in March, so there is an opportunity for those entities to actively engage with how this program is going to evolve. Just listed a couple of cases up there, excuse me, on the screen that have been decided, all in calendar 2021, which have relevance to the charity sector in particular, not so much the broader not-for-profit, but those charities which are registered with the ACNC. The first one is Global Citizen versus the Commissioner of the ACNC. In that case, so that case is an interesting one. It's the first court discussion of the term public benevolent institution and what it means since the Hunger Project case in 2014. It's also worth noting that the High Court has not considered the definition of a PBI since 1942. But essentially what this case did was it came out and essentially reinforced what had been said in Hunger Project, which was basically that a public benevolent institution does not have to be one that is providing direct relief. And I guess if we're to think about what we think of as a benevolent institution, you're thinking of a homeless shelter, or you're thinking of a soup kitchen, or an organisation that provides direct on-the-ground frontline relief. What this case is confirming is that that is not the provision of that direct relief which necessarily is required in order to be a public benevolent institution. So it's getting to a more contemporary understanding of PBIs, and as I say, reinforce the older interpretation in the Hunger Project case. In Cancer and Bowel Research Australia Limited, this is an interesting one. The snapshot that I've put up there on the screen of what the case was about is a little misleading in that it, I mean, it's true, but essentially it does sort of make it sound a bit like the organisation was trying to do something that was a bit dodgy. And ultimately, it wasn't, or in some ways it wasn't. Essentially what had happened here was that there was an existing charity, which as a result of a mismanagement of a prior CEO had failed to pay superannuation guarantee charge to the tax office. The new CEO formed the view that it wasn't appropriate for funds that were being raised from the public going forward to be used to pay historical debt that arose as a result of CEO mismanagement. He gave evidence to that effect in the case. The judge was, reasonably sympathetic to it, understood, appreciated the view, but in the end formed the view that while that on one level made sense, it wasn't appropriate, and to establish an organisation, albeit with charitable purpose of raising funds to be used for the purpose of raising money for cancer research, it was also a purpose of creating a new organisation to avoid that debt being paid to the tax office. And then as such, it did not qualify for registration as a charity. The third one is Angel Loop versus Commissioner of the ACNC. This is not the first case dealing with a charity similar to this, but essentially this was an organisation set up to encourage entrepreneurship and also as a byproduct or as part of that to connect entrepreneurs with angel investors. While the ACNC recognised that the encouragement of entrepreneurship was a charitable purpose, and there was a case a few years ago with an organisation called Triton which had a similar purpose, in this case, the court found that the purpose of connecting entrepreneurs with angel investors and actually forming a commercial deal was the predominant purpose, or was a not insignificant purpose, and that was enough to mean that the encouragement of entrepreneurship was not the only purpose. And on the basis that there was another main purpose that was not charitable, on that basis, the charity was denied registration with the ACNC. The final case, Buddhist Society of Western Australia. This was where the ATO had decided to revoke a DGR status for a building fund, and the federal court set aside that decision. And the reason it is of interest, particularly for entities that are operating in that space, is it did have some discussion around the meaning of school and how we determine when a building is to be used for the purposes of a school. So I'll now hand over to Bruno to take us through some more accounting information.
Thanks, Kayleen. So let's dive into some financial and reporting reminders for this 30 June year end. As many of you would be aware, AASB 1060 Simplified Disclosures was introduced as part of the AASB's project to review the financial and reporting framework in Australia. It has replaced the old General Purpose Financial Statements Tier 2 Reduced Disclosure Requirements and is mandatorily effective for reporting periods commencing on or after 1 July 2021. We have discussed this in detail in our last webinar, but as a reminder, we have some of the key features and benefits of the Simplified Disclosure Standard summarised here on the slide. The good news is, for those coming from the old RDR framework, there is a general reduction in disclosures required. For example, when certain criteria are met, the option not to present a statement of changes in equity. The standard also provides the principles and methodology required for determining any Tier 2 disclosures going forward. One of the biggest benefits of this new standard is that it replaces all the RDR disclosures that were dispersed amongst the relevant Australian accounting standards. This means you will no longer need to look through each standard to understand what needs to be disclosed. It is all located in one easy-to-read standard. I'll now pass you on to Julie, who will provide you an update on the Australian Financial Reporting Framework.
Thank you, Bruno. So as already noted today, the Australian Accounting Standards Board has been working on a new Australian financial reporting framework. And this was essentially brought about when the revised conceptual framework was released internationally, and it had a definition of reporting entity that was different to the reporting entity concept that we understood in Australia for very many years. So the AASB split this project between the for-profit and not-for-profit sectors. So whilst the financial reporting framework for for-profit entities for 30 June 2022 is going to be changing significantly, for not-for-profit entities, this is still very much a work in progress. So I'm not going to go into detail about the changes of the for-profit framework, although I will just highlight a couple of key features. The first was that the introduction of the new framework did result in certain for-profit entities no longer being able to prepare special purpose financial statements. And it also introduced the new Tier 2 Simplified Disclosure Standard that Bruno just highlighted before. So what about the not-for-profit framework? Well, the AASB has an active project considering this framework at the moment, and is expected to release a discussion paper later in this calendar year, seeking submissions and comment on that. Interestingly, they are looking at developing a third tier for not-for-profit sector, which will not only have reduced disclosures, but also some simplified recognition and measurement requirements. And the expectation is that this third tier would potentially be fit for purpose for those medium-sized charities out there. So, but the question that I would like to focus on is, well, what does this mean for 30 June 2022 for not-for-profit financial reporters? Well, firstly, if you are preparing Tier 2 general purpose financial statements, then as Bruno has highlighted, the reduced disclosure regime no longer exists. You must transition to the new AASB 1060 Simplified Disclosure Standard and report in accordance with the disclosures in that standard. Where you intend to prepare Tier 1 general purpose financial statements, there's been no change in that regard. So you can continue to do so and continue to comply with all the relevant accounting standards when you prepare your financial statements. And so that brings us to special purpose financial statements. Well, the good news is that for 30 June 2022, there is no impact. So what that means is that if you are a non-reporting entity, you can still prepare special purpose financial statements for 30 June 2022. The old conceptual framework still applies. The reporting entity concept still applies. And this will only change once the AASB finalises the not-for-profit financial reporting framework. So with that, I'll just hand back to Bruno to discuss some of the ACNC developments.
Thanks, Julie. In addition to the threshold changes that was highlighted by Kayleen earlier, further changes to the ACNC regulations will see charities still preparing special purpose financial statements now required to disclose elements of AASB 124 related party disclosures within their financial statements. However, what disclosures are required and when will depend on the charity size. So let's explore further. Where a large charity prepares special purpose financial statements, they will now also be required to disclose the remuneration of key management personnel, or KMP for short. As shown on screen, a KMP is defined as those persons having authority and responsibility for planning, directing, and controlling activities of the entity. Determining who the relevant KMP are will require judgment, and it may vary from organisation to organisation. However, these are often those senior executives within the organisation, such as directors, CEOs, and board members. Some charities may also have KMPs who are not employees, but provide this service through a separate entity for a fee. These personnel will still need to be considered and assessed for purposes of this disclosure. The ACNC has exercised their discretion and will allow the remuneration to be disclosed as one total within the financial statements and not by subcategory as outlined in the accounting standard. Entities may still comply with these requirements in full if they wish, which would see this balance broken down into 5 categories. If a charity assesses that they only have one KMP though, then they are exempt from making this disclosure altogether. This disclosure will be effective for the 2022 annual information statement years, which for most charities will be this coming financial year ending 30 June 2022. If we look forward a little into next year, the remaining related party transaction disclosures of the standard will also be required for those medium and large charities still preparing special purpose financial statements. Now, the concept of related party and related party transactions, whilst new for some charities, is not a new accounting standard or concept. Those preparing general purpose financial statements, whether Tier 1 or Tier 2, should already be making these relevant disclosures and assessments within their financial statements. Julie, it would be great to get some of your input here. Can you please provide a quick refresh of these concepts and some common examples in an NFP context?
Yes, Bruno, I'd be happy to. So just to give you a couple of definitions to help you first, a related party transaction is a transfer of resources, services or obligations to a related party, regardless of whether a price is charged or not. A related party is a person or a close family member of that person, or an entity that has control or significantly influences, or is controlled or significantly influenced by the reporting entity. A related party can also be a KMP of the reporting entity. In terms of common examples that we see, I guess that the one that readily comes to mind is in relation to larger religious organisations, where you may have an administrative entity that within the organisation which supports the cash management and financing activities, or perhaps owns the assets which are used by the entities within the wider group. So in relation to that, for the standalone financial statements for the subsidiaries receiving these benefits, the related party would be the administrative entity, and the related party transaction would be the cash sweep or the financing arrangements provided, or there may be a lease between the administrative entity and the subsidiary of the group. Another example that we do see quite frequently is also perhaps where there are significant donations that might, particularly perhaps the use of an asset for little or no consideration, and that might be provided by a director of the charity themselves. So, Bruno, as you have already said, in where these transactions do occur, the nature of these related transactions should be disclosed within the financial statements. That's what's going to be required under these requirements.
Okay, great. Thanks for that summary, Julie. So whilst the changes for KMP are effective for 30 June 2022, the changes for related party transactions are effective 1 year later. That is from the 2023 annual information statement year, which for most charities is the financial year ending 30 June 2023. It's also worth noting that the ACNC Commissioner has advised that comparative disclosures will not be required in the first year of adoption and will only need to be disclosed in periods following mandatory application. Now, as you can see, some of these changes will have an impact this coming 30 June 2022 year end, and for others 2023, and this has been deliberately designed in the adjustments to the regulation. This is because some charities will need to change their current data systems and controls to ensure that the information required for these disclosures is appropriately captured. As such, we strongly recommend charities look at their systems now and implement changes as early as possible. An ongoing issue raised by the sector with the AASB, and that we often get asked about, is concessionary or peppercorn leases and the temporary exemption that was initially provided. As a quick refresh, a concessionary or peppercorn lease are those leases provided at below market terms to enable an NFP to further its objectives. But what was the benefit of the exemption? Let's consider the following as an example. So we've got a simple land lease for 5 years. where the concessionary below market lease cost awarded to the charity is $60 over the entire period. The same lease, though, at market value would have deemed to be worth $100. And for the purposes of this example, we will ignore the impact of discounting. So without the exemption, AASB 1058, income for not-for-profit entities, and AASB 16 leases would see you recognise a right-of-use asset for $100 at fair market value, a lease liability reflecting the cash cost element of $60, and the $40 difference between these two would have been immediately recognised as income. That $100 ROU asset would then need to be depreciated for the next 5 years into the P&L. But if you were to use the exemption, both the ROU asset and liability would match on day one, being recognised at $60, resulting in no impact to your P&L. Furthermore, assuming even lease payments over the 5 years and putting aside the issue of discounting, your depreciation expense will closely match the actual cash payment incurred by the charity. The AASB have since considered feedback from stakeholders and have confirmed that this temporary option will be made a permanent accounting policy option for certain NFPs. This exemption, however, has only been made available to private sector NFPs. The decision on whether this will be extended to public sector NFPs has been deferred until the outcomes of a couple of ongoing projects impacting the sector are known, namely the International Public Sector Accounting Standards Board, or IPSASB, leases project, and the AASB exposure draft on modification of AASB 13 fair value measurement for public sector entities. And finally, when is all this happening? So the proposal to make this optional accounting policy choice permanent was put forward as part of exposure draft 318, which Julie will talk to more shortly. The feedback received was overwhelmingly in support to keep this temporary exemption as a permanent feature. No amendment will be made to the standards, but this decision will be formally documented within the basis for conclusions and is expected to be finalised in June 2022. Now, we have already discussed the new simplified disclosure standard earlier in the webinar, but on this slide, we have summarised all the newly effective standards and IFRIC agenda decisions we believe may have an impact to the not-for-profit entities this 30 June 2022 reporting season. Now, for clarity, an IFRIC agenda decision or an IFRS Interpretations Committee agenda decision is exactly as the name suggests. It's an interpretation made by the IFRS Committee on issues presented to them. Organisations are required to assess the impact, if any, of these interpretations on their accounting policies and make adjustments as necessary in a timely manner to their financial statements. One of the key developing agenda decisions concerns cash demand deposits, with restrictions on use imposed by a third party who is not the bank. The changes here could result in a reclassification of these deposits from other financial assets to cash and cash equivalents on the balance sheet, and obviously an additional amount to consider in the cash flow statement. However, we will not discuss these in detail today, and this is not a complete list of all the pronouncements. Therefore, I encourage you to register for our general 30 June 2022 reporting update to be held on the 10th and 17th of May to understand the impacts of adopting these pronouncements. It's also worth highlighting that these pronouncements have been summarised in KPMG's Standards on Issue and IFRIC Agenda Decision Summary, which you can access on the KPMG Financial Reporting website. Also, all of the not-for-profit specific financial reporting matters we are discussing today are included in our reporting update number 9. This is a very useful resource, and we would recommend those on the call today to come back and to consider these factors heading into 30 June reporting. I'll now pass back to Julie, who will take us through some further developments from the AASB.
Well, thanks again, Bruno. So the AASB has also received a lot of stakeholder feedback relating to concerns in implementing the revenue standard, AASB 15, in the not-for-profit context, as well as the specific standard for recognition of income for not-for-profit entities, AASB 1058. So the feedback came from various directions, and this has resulted in what I would term a laundry list of issues. These issues have been progressively brought by the AASB staff to the board over the past few months, and they have suggested various ways and methods to handle these, issues, and they fall into three main categories. The first one is to propose some narrow scope amendments. The second would be to deal with the issues in the post-implementation review of the standards. And I will explain what that is shortly. And then the third way in which to deal with the issues is to provide further educational material. So the AASB staff has said that they would provide further information and education material so that to help preparers in applying the requirements of the standards. So they hosted a webinar in March, and they have also updated and amended some of their FAQs, both of which are available on the AASB website. But before I move to the narrow scope amendments and give a little bit of a summary of that, I'll come back and explain what a post-implementation review is. This is, as it sounds, by the name, it is a review undertaken a few years after the effective date of the new standard. And it really assesses whether the standard is solving the problems that it was intended to, whether it is meeting its objectives. It's not intended to be a reconsideration of the underlying accounting standard, but instead acknowledges that the consultation and due process is no substitute for the practical application of the requirements. So, for example, when new requirements are applied in practice, unexpected issues may arise, such as it being more difficult or more costly to apply the requirements. Also, there might be some situations where the standard unintentionally creates divergence in practice as the standard is applied. And this divergence could be either due to the judgment that's involved in applying the standard or because the requirements are not sufficiently clear. So the AASB is doing a post-implementation review of the two standards this calendar year. So, and is looking to address a lot of the issues that were raised as part of that review. But back to the narrow scope amendments proposed in Exposure Draft 318. So as Bruno has already mentioned, this exposure draft was issued in January and was seeking to address three of the issues that were raised by the stakeholders. Now, importantly, it did not propose to change any of the standard itself. What it did propose was firstly to add a new illustrative example in AASB 15 relating to upfront fees to provide an illustrative example that was helpful for not-for-profit entities. And these upfront fees are things like perhaps an enrolment fee for a school. And so the question that is addressed in this illustrative example and looked at is whether you would recognise that upfront fee immediately or whether you would recognise it over the period in which the service and the future services were provided. The second proposal in the exposure draft was to amend an existing illustrative example in AASB 1058, and that was in relation to the recognition of a financial liability. And that is illustrative example number 3A, for those of you who are knowledgeable of the standard, and it dealt with the provision of cash scholarships. And the third issue that it dealt with was that concessionary lease option to make the cost option of recognition of the right of use asset permanent rather than temporary for private sector not-for-profit entities. Now, submissions were received, and this exposure draft has been discussed at the board already. What the board decided was that they would include the new illustrative example in AASB 15 on the upfront fees, and they confirmed the concessionary lease option to be made permanent for those entities. But it decided that in relation to the amendments proposed to illustrative example 3A, that they would defer that until they could look at it in more depth as part of the post-implementation review. So in relation to this particular ED, there is an amended standard that is going to be issued we're expecting that this month, and it will be effective for financial years commencing on the 1st of July 2022. But given the ongoing discussions and certainly the list of issues that were identified, I recommend that you keep an eye out for that call for involvement in the post-implementation review of the two standards and to get involved, particularly if you experienced challenges in applying the requirements of the two standards. So I'll now pass on to Shara, who will discuss the remaining financial reporting matters.
Thanks, Julie. So for those of you who provide residential aged care, you'll be aware that there was an announcement in last year's federal budget that there was an intention to discontinue aged care approval rounds. From 1 July 2024, aged care places, commonly known as bed licences, are set to be allocated directly to senior Australians rather than the current model, which assigns those places to aged care providers. Further announcements on this topic was released in the September 2021 Department of Health discussion paper, Improving Choice in Residential Aged Care, ACAR discontinuation. In reference to the discussion paper, ASIC released an FAQ response on the 29th of September 2021 on this topic. ASIC's FAQ covers two main areas: amortisation of licences and impairment testing. So, what will be the impact for your 30 June 2022 financial reporting based on this FAQ? So firstly, on amortisation of licences, it is our view the bed licences will be reassessed from indefinite life to finite life. Amortisation should commence on a straight line basis from 1 October 2021 through to 30 June 2024. The amortisation start date is immediately following the release of the Department of Health discussion paper, as this is the point at which there is more certainty that the legislative changes will actually occur. So next we'll consider impairment testing, and in our view the carrying value of bed licences should continue to be tested for impairment each year. Bed licences will continue to form part of the CGU assessment unless they're held for sale, in which case impairment assessment will be at the licence level. Now, this guidance is also consistent with ASIC's view as outlined in its FAQ. Another thing to note is that the change in useful life should be treated as a change in estimate and applied prospectively from 1 October 2021. So there's no need for restatement. As a reminder, the listed aged care providers, being SDR and Regis, have already adopted this treatment in their 31 December 2021 half-year reporting. We encourage you to have a look at those disclosures as you are preparing to implement this for your 30 June 2022 financial statements. So I'll move on to charitable fundraising now. So for those of you who run fundraising activities, you'll be aware that the laws and regulations are state-based and they can be complex to follow. Laws and regulations for New South Wales and WA licence holders have recently been revised with the aim of reducing red tape for those charities registered with the ACNC. Over the next two slides, I'll highlight the key changes for each of those jurisdictions, starting with New South Wales. So providing organisations that are registered with the ACNC, you will now be automatically eligible for an authority to fundraise. All authority holders will now be required to submit an annual return, annual financial statements and compliance statements within 6 months of the year end. And this is still a requirement even if there has been no money raised under that authority during the year. For those registered with the ACNC, this reporting can be done once through the ACNC portal, and you're no longer required to submit these to the Department of Fair Trading as well. An audit requirement still remains for those who fundraise more than $250,000 in the financial year, and specific notes to the financial statements are required for fundraising appeals which exceed $100,000 in aggregate in the financial year. So moving on to WA, the changes are a little bit more substantive. So specific audit requirements pursuant to the WA Charitable Collections Act 1946 and the regulations related to those have now been repealed. Licence holders who are also registered charities with the ACNC will no longer be required to submit an annual statement to Consumer Protection, which is the WA regulator, or provide copies of financial reports. Consumer Protection will issue continuous licences. Charities were previously required to renew their licence every 3 years. This exemption is conditional on the licence holder meeting its annual reporting obligations to the ACNC. To participate in this arrangement, charities must provide their WA fundraising licence number when submitting the annual information statement each year. So I'll now hand over to Steve for a wrap-up of the session.
So thank you, Sharon. Thank you to all the presenters today. That substantially wraps up the content that we were presenting in today's webinar. And on this page, we've given some of the key takeaways for you to consider as you approach your reporting this 30 June for this 30 June reporting season, and also your compliance obligations. Hopefully today's presentation has assisted you in our objectives at the intro of this presentation, but we would also welcome your attendance at our 30 June focused reporting webinar for for-profit entities to be held on the 10th and 17th of May, for which the registration link will also be included in our post-webinar communications. We're now going to spend some time looking at the questions that some of you have sent through the Q&A function through today's session. So fantastic. So we've had a number of questions come through the Q&A function. So I think I've actually got a question for each of the presenters today, which is fantastic. So the first one, Julie, and I might pass this one to you. There's been a number of questions around disclosures, particularly with AASB 1060. One of our participants has obviously listened very carefully to our webinars in the past and asking a question around whether there is any relief from providing comparatives when you're doing simplified disclosures.
Yeah, thanks, Steve. That's a good question and an important one. When the AASB issued the standard, they did provide some relief, but it was only if you adopted the standard early. So if you're doing preparing financial statements for 30 June 2022, and this is the first time that you're applying AASB 1060, the Simplified Disclosure Standard, then you do need to provide full comparative information for any disclosures that you make in the current year.
Excellent. Thank you for that, Julie. And what I should say in response to another question is we do have disclosure checklists and example financial statements for simplified disclosures that we can share with clients, and they are available on our financial reporting website as well. Bruno, KMP disclosures are a hot topic as well. Start off with a generic question for you. So the participant entity currently prepares Tier 2 general purpose financial statements and have been doing both KMP disclosures and related party disclosures previously. Have they been doing too much?
So if the entity has been preparing... Oh, sorry, am I on mute? Sorry. Thanks for that, Steve. Apologies.
No, we can hear you, Bruno.
So, yes, no, they haven't been disclosing. Okay. So, no, they haven't been disclosing too much. So if the entity has been preparing general purpose in the past, then they would have already been meeting all the requirements for those disclosures. So those KMP remuneration disclosures and related party transaction disclosures that we said were new for FY22 and FY23, they are only applicable for medium and large size charities that are still preparing special purpose financial statements.
Excellent. Thanks, Bruno. And as I said, it was a hot topic. So 2 further questions for you on KMP disclosures. So I'll give you them both together. So the first, does the exemption on disclosing KMP disclosures apply if the entity's got more than one KMP, but only one of those KMP is remunerated? And then the second question was, do you need to separately disclose each of the individual components of KMP remuneration, or can you do it all as one combined benefit?
Cool. Thanks for that one, Steve. So that first one in particular is a good question. It's an interesting one. So if you were to read the guidance handed out by the ACNC and apply it on a technical basis and apply it strictly, chances are if they've got multiple KMP, then that exemption wouldn't apply. but we can speak to our contacts at the ACNC just to double check what the intention was behind that disclosure and behind providing that exemption if only one actually does receive some remuneration benefit. And to the second point around combining the benefit for the KMP, so it is just one number disclosed for all KMP and for all categories of remuneration. So just that one total gets disclosed in the financial statements.
Excellent. Thank you, Bruno. So, Kayleen, a question for you, just in terms of your section. What are the main concerns for the ACNC in respect of charities, and where are they focusing their review activities?
Thanks, Stephen. So excuse me. Excuse me. The main focus for the ACNC is governance. And interestingly enough, most of that review activity regarding governance is directed at charities that are less than 5 years old. So it's important, I suppose, that probably reflects that charities that have been going for a period of time have had a chance to sort of get their house in order and have been operating and have implemented a lot of those governance procedures and processes and policies. But yeah, that would be the main thing. In particular, there has been a focus and a recognition by the ACNC that not-for-profits can be more vulnerable to trafficking of their funds when they are working with overseas organisations. So to that end, the ACNC developed the ACNC external conduct standards, which are additional to the ACNC governance standards. There's 4 of those, which are very directed to making sure that charities take reasonable steps to ensure appropriate governance, oversight and standards of behaviour when they're operating overseas.
Excellent. Thank you, Kayleen. And then, Shara, over to you. Obviously, a question here from an aged care provider on your piece at the end. And a very simple question. Can I just write off all my bed licences this financial year?
Thanks, Dave. So it's definitely a question I've been asked before. So in the period between now and the date of deregulation, it's really likely that there is still some value held in them because there's still restrictions on the number of beds that competitors in your geographic location can add over that period. However, the announcement could actually be an indicator of an impairment. And any known factors to your organisation should be considered when preparing your impairment models. So some of the things you could be asking yourself around this are, what are the barriers of entry to competition in my particular geographic location? Is there any knowledge of new market entrants coming? How long would it actually take for a new market entrant to ramp up operations or existing ones to expand their capacity post-deregulation? And also, what's your actual internal strategy on a facility-by-facility basis across your own portfolio? Now, depending on the outcome of your assessment, it is possible that some level of impairment could exist this financial year. However, it would be on a case-by-case basis, depending on specific circumstances to your own organisation. Just want to remind you as well that any impairment testing will need to be at the CGU level. And you will need to then factor in any of these expected impacts into the calculation for a recoverable amount, but it certainly is possible.
Excellent. Thank you, Shara. Well, we're coming up close to 1 o'clock, so I think we'll draw the Q&A to an end there. But if we haven't answered your question, then your normal KPMG contact will get back to you shortly after the end of this webinar. We will also be following up with each of the participants on today's call with our normal post-webinar communications, which will include a link to our webpage where we host a recording of this webinar. We'll also be sharing with you all a copy of the slides that I know you all value, and also providing links to those for-profit webinars that we mentioned in the introduction. So thank you all for attending today. I hope you found it really useful in terms of preparing yourselves for this 30 June's reporting season and also your regulatory and compliance activities. Also in those post-webinar comms will be an opportunity for you to provide feedback, any topics you'd like to hear more of. But we've enjoyed today. Thank you again to the presenters and hope you all have a fantastic afternoon. Take care.